In this video, we'll have a bit of a chat about what is a territorial tax country, a territorial tax system. We'll talk about what countries in Asia operate under this kind of tax system, and then towards the end of the video, we'll discuss a general procedure on how you would go about using a territorial tax country as part of your tax minimization and tax planning strategy. My name's Aaron, I'm from Offshore in Asia. We help people move, invest, and do business out in Asia. So if you're interested in this kind of thing, head over to offshoreinasia.com, have a look around there, and we might be able to help you get out here and living the life that you want to live. All right, so what is a territorial based tax system? Well, generally there are two main types of taxation that countries tend to operate under. That is territorial systems and residency-based systems. There's also citizen-based taxation, and the United States are quite well known for being one of two countries in the world who employ this method of taxation. But if you are an American, there is a get out of jail card there with a foreign earned income exclusion, so it's not all lost. But in this video, we're talking about territorial based taxation, mainly in comparison to a residency-based system. So a residency-based tax system is a country that bases you on your residence. If you are a resident of that country, they tend to tax your worldwide income. And most countries that viewers of this channel will come from, people who are interested in moving out to Asia, not just for the lifestyle, but maybe for some better taxation as well, a better place to do business perhaps. Countries such as Australia, New Zealand, Canada, the UK, most Western countries tend to employ a residency-based taxation system. So if you're regarded as a resident, they will tax you on your worldwide income in very general terms. Now, a territorial-based country, the main topic for this video, this is a country that will tax you on income earned within its own borders only, within its territory. So they will generally not tax foreign-sourced income. So if you are a resident of a country that operates under a territorial-based tax system, if you have income that comes from abroad, they won't tax that in very general terms. It's important to note that just because you are a resident of a territorial-based country doesn't mean that there is a blanket rule for not taxing offshore income. Every country has its own rules, conditions, and exemptions that are in place around foreign-sourced income. So it's important to have a close look at the rules that particular country that you are in operates under as to whether your foreign-sourced income will be taxed or not. And from that, some territorial-based countries will have more favorable operating conditions than other countries. So have a good look at that when you're making your decisions on where you want to live, where you want to do business, where you want to invest. So now looking at Asia, where we focus our business. And again, in very general terms, I can't get into all the fine detail in this video, but looking at the territorial-based countries in Asia here, first we have Thailand, which does not tax foreign-sourced income unless remitted. And those who have been following this has been a very hot topic online when the Thai Revenue Department late last year announced that they were going to remove an exemption, change the guidance on the way they were going to tax foreign sourced income. In the past, if you didn't remit income into Thailand in the year that it was earned, you didn't pay tax on it. They're changing that now to that it will be taxable if you remit it into Thailand. So if you earn income offshore and you're a resident of Thailand, but you don't remit that money into Thailand, that generally will not be taxable under the new interpretation of the rules. Next up is Malaysia. Malaysia is a great country because they have a tax system that works pretty similar to Singapore, but it is a lot cheaper to live in Malaysia than it is in Singapore, of course, if you've ever been to those two countries. Now, they don't tax foreign source income, but there is a new rule coming into play in 2026 where, similar to Thailand, they will start taxing certain types of foreign sourced income if you remit it into Malaysia. If you don't remit it, they won't tax it. Philippines, which is also very popular with expats and retirees in Asia, they don't tax foreign sourced income. Now, they're the three main countries in Asia that operate under a territorial-based tax system for people who are focused on a lower cost of living. If that is not so much your focus, if you are earning a higher income, if you're in business, or if you have some investments that are earning you a higher income, you might want to look at Singapore. Singapore doesn't tax foreign sourced income. You can remit money into a Singapore bank that was earned abroad, and you usually will not pay tax on that, but you may have to prove that that income was already taxed elsewhere before you remitted it into Singapore. Hong Kong is the other place that is in a similar league to Singapore for the people of the higher net worth, the higher income earners. Hong Kong only taxes income that is earned within the Hong Kong territory. So that can work for you as well, depending on your particular circumstance. Okay, so how do you actually put all this together and start generating a plan to lower your taxation? Well, the general process is, well, first we have to say this, and we say it all the time, that everyone's situation is different. We can't give out specific advice on this channel because it's not possible. Depending on what your income is, depending on where you're living, depending on where you come from, there are many factors at play. Where your investments are based, it's going to be different for everyone. And what's working for you won't necessarily work for the guy next door. So you got to do your own analysis on that. And if you want to reach out to someone who can help you do that, we can help you do that. You can get in touch for a consult by heading over to offshoreinasia.com. There's a book a call icon in the top right-hand corner, and you can click on that and select a time to have a chat with us with a one-on-one consultation. So the first thing is you look at where you might want to live, whether cost of living is an important part for you, what your investments are and so on, where you want to base various things, where you do business, that comes into it as well. And as I touched on before, simply residing in a territorial-based country doesn't get you off the hook for taxation. You've got to look at that country's particular rules. So Thailand and Malaysia and the Philippines, they're all territorial-based countries, but they all go about how they administer tax in a different way. So you're going to narrow it down to some of the countries that you might be interested in. The next thing you need to do is have a look at what are your income types. Do you have rental income, properties that are based back home in your home country or another country overseas outside of the country that you're planning to move to? Do you have dividend income? Do you have capital gains? Do you have crypto? Do you do stock trading on a regular basis? That might be regarded as income rather than capital gains. And a lot of you will have business income as well. And that's where things can get even more interesting, because then you have to start looking at things like permanent establishment and where your business is incorporated and that kind of thing. You may even have bond income. It could be corporate bonds, government bonds. You might have interest in bank accounts, high yield accounts that's earning you an income. You have to look at where your income is coming from, because all these different types of incomes will have different tax treatment. And then you have to look at the countries that you're interested in, and do they tax these particular types of income? As I said, every country has its own rules. Some countries will tax based on if the money is remitted or if it is left offshore. Some countries don't tax dividends, some countries don't tax capital. So what's best for you will depend on these kinds of things. You've got to look at the rules for every different type of income that you earn. And don't get stuck in sort of trying to find the holy grail of tax-free countries, because no country is perfect. There might be a country that has quite an attractive tax regime, but you may hate living there. You have to enjoy living in the place. That's probably the most important thing. And then after that, you're trying to make sure that you're not taxed so heavily that your money can then provide you with a good lifestyle. It can still work out favorably for you in a tax minimization plan if a country does tax you on a certain type of income, but if they just have a light touch, if they don't go too heavy on it, it can still work out for you. So be open to various countries when you're going through this process, and don't rule a country out just because it has a certain tax on a certain type of income. All right, so now you've narrowed down which countries you may want to live in, you've identified your main income types, and you've identified how these particular countries will tax those different income types. But that's not the end of the story. Now you want to look at the double taxation agreements, the tax treaties between, if you are regarded as a resident in more than one country. That's very possible, especially when you're making the transition from your old country to your new country. You also want to look at tax treaties in regards to where you are incorporated versus where you are living, where your investments are located versus where you are living. All of this stuff is often covered in the tax treaty between two countries. And this is very important, because the tax treaty, which is a bilateral agreement between two countries, it takes precedent over the domestic country's laws. So if a tax treaty says that dividends are taxed at 15%, but the country you're living in, their domestic laws say that dividends are taxed at 30%, then the tax treaty rate is the rate that you'll be looking at. The tax treaty overrides domestic rules. So you need to pay close attention when you're going through that. They can be very complex, they can be very vague. Again, this is something we can help you with if you're interested. So while there are a lot of opportunities for tax minimization in Asia, you need to still be careful about how you go about it. You may want to look at, do you move property investments that you have in certain countries? Do you move your stock portfolio to a certain country that doesn't tax dividends and doesn't tax capital? And then how are you going to live? As in, are you going to remit money into the country that is going to be taxed? Is there a way to get money into a country legally, of course, that will not be regarded as income and therefore will not be taxable? These are all things you can look at as far as your tax minimization plan goes. Now, if you're interested in getting help, like I said, offshoreinasia.com. Otherwise, I hope I've given you a bit of a better understanding as far as your tax minimization and your expatriation plans go. There is a lot to think about, so we'll leave it there. Thanks a lot for watching, guys. We'll catch you later.